Bob is an accountant. Bob is an accountant in town who is familiar with general business conditions. Bob gathered the following information for Ami. There are 50 growers within a 1-hour drive of Ami's acreage. In general, there is little variability in price. Flowers are treated as commodities, and one aster is considered to be pretty much like any other aster. There are numerous florists in the city, and the amount that Ami would supply could be easily absorbed by the florist at the prevailing price. Now, question number 1, what type of market structure characterizes the flower growing industry in Ami's region? Explain. Now, with regards to the market structure, we have so far discussed in the PowerPoint presentation the different types of market structures. So that includes monopolistic, oligopolistic, perfect competition. I hope you will recall and you will study again what are included as your market structures. Now here, as stated, the flower growing industry has the characteristics of perfect competition. There are many buyers and sellers, no one of which has much control over the market price and quantity sold. The price will not be affected by Ami's entrance into the market. The barriers to entry are low. There appears to be good information regarding prices charged. So in other words, we have the flower growing industry now considered to be a perfect competition, and take note of the characteristics like many buyers and sellers, and at the same time the barriers to entry are low. So take note that we have now your perfect competition. Now the second question, given your answer to requirement 1, what price should Ami charge per standard bunch? Given perfectly competitive structure, Ami should charge 1.50 per bunch. She can sell all that she wants to at the price. To charge less would give away profit. Note that if Ami felt she needed to charge more than 1.50, it is likely that none of her flowers would be sold. So really, it's perfect competition. Now next, we go to exercise 2-13. Exercise 2-13. We have now the markup on cost-based pricing. 2-13. Given the preceding information, what is the markup percentage on total direct cost? And as stated in the problem, direct cost, the bid should include direct cost and subcontractor cost, as well as an amount referred to as overhead and profit. The bidding policy is to estimate the cost of direct materials, direct labor, and subcontractors' cost. These are total, and the markup is applied to cover overhead and profit. In the coming year, the company believes it will be the successful bidder on 10 jobs with the following total revenue and cost. Okay, so we have now your total revenue and cost. So we have now the revenue, and we have the sum of direct materials, direct labor, and subcontractors cost considered to be the direct cost. So in this case, the direct cost will be treated as the denominator for this type of determination of the markup percentage on total direct cost. Okay, so we have now the total direct cost equal to 7,600,000. 7,600,000. And we have the overhead and profit. Overhead and profit equal to 1,140,000. Take note that we have now the overhead and profit. The overhead and profit. Now, 1,140,000 includes overhead, not only profit. So, meaning the markup percentage based on total direct cost includes the overhead in your numerator. So we have now the markup percentage of 1,140,000 divided by 7.6 million. So we have 15%. The markup percentage on your total cost, no? Direct cost. So if the company now is asked to bid on a job with a direct cost of 570,000 as estimated, what is the bid? If the customer complains that the profit seems pretty high, how might Killian counter that acquisition? Okay, so we have now the bid is 570,000 and we add 15% of 570,000. That will give us the bid price. Gillian should remind the customer that the 15% markup on direct cost is not pure profit because the numerator still includes overhead as well. So in other words, the amount of 1,140,000 is not pure profit. Now we go to 2017. We have now 2017 cost-based pricing or target pricing. 2017. The requirement of the problem, explain where cost 2017 explain where costs for Karina's services and profit are calculated in the preceding bid. Okay, so in 2017, Karina's labor and profit are embedded in the material prices quoted. For example, the food preparation includes numerous activities such as recipe selection, food purchase, and preparation. Transporting the food to the church, setting up the tables, serving and overseeing staff throughout the party, and clean up. The rental of the dance floor includes finding and ordering the floor, picking it up, and transporting it to the church, setting it up, clearing it down afterwards, and returning it. Now, suppose that the Monteros, amo ni ang customers. Blanche, when they see the preceding bid, one of them suggests that they had hoped to spend no more than $10,000 or so on the party. How could Karina work with the Monteros to achieve a target cost of that amount? Now, Karina will need to sit down with Maria and Stefan and determine which features of the party are most important to them and which are less important. For example, perhaps instead of a sit-down dinner, they would accept a buffet, which would cost less and require less serving time. The open bar could be replaced by champagne, punch, and soft drinks. The party time could be reduced. Finally, they could invite fewer people. Now, considering that the customers now are uh, hoping that they will spend no more than $10,000. Stefan Mortero protests the cost of dance floor rental. He said, I've seen those for rent and you rent it for $75. How would you respond to this remark if you were Karina? You want this job, and so telling him, uh, go ahead and do it yourself. Okay, and do it yourself. Cheapskate is not an option. So it's not an option. Okay, so we have now, Karina should remind Mr. Montero that there are many activities involved in renting and setting up the dance floor. Her rental price for the dance floor includes finding and ordering the floor, picking it up and transporting it to the church, setting it up, tearing it down afterwards, and returning it. She might also suggest that he could rent it himself and handle all activities involved with the floor. Next, we have problem 2-19, life cycle. Compute the sales price variance, the sales volume. And so we have now the problem 2-19, 18-19. Now we have the formula for the sales price variance. We are comparing the budgeted price with the actual price and multiply the difference by the actual quantity sold. Now, based on the comparison of the budgeted price and the actual price, there is a variance equal to 20 cents, and you multiply that by 2,500 units, so the variance is $500 is unfavorable. It's unfavorable because considering that this is a revenue item, sales price, and if the budgeted price exceeds the actual price, meaning the variance is really unfavorable. Now, for the sales volume variance, we are trying to compare the actual volume of 2,500 units with the budgeted volume of 1,450. In other words, there is a big difference in terms of the sales in units, and it's favorable because the actual units sold exceeded the budgeted, and we multiply that by 15, the budgeted price. So take note of the formula. Number 3, suppose that the product is in the introductory stage. What information do these two variances provide to the managers? This product looks like it might be entering the growth phase of the product life cycle. While price is slightly lower than budgeted, the quantity is much higher. This could, of course, be due to other factors as well. However, the manager should consider the growth possibility to allow for potential increases in the production and sales of the product. Now we go to 20, pricing strategy and sales variances. Number 1, calculate the sales price and sales volume variances for each of the 3 products based on the original budget. Now the company sells 3 products. So for each of these products, we are going to determine the sales price and also the sales volume variances. So let's begin with product R. The actual volume is to be computed by dividing the sales revenue of R by the sales price per unit. So we get 123,000 units. That's the actual volume. So the sales price variance is the difference between 26, which is the budgeted price, and 25, which is the actual price, and we multiply by the actual units. Since the budgeted exceeds the actual sales price, meaning the variance is unfavorable. Now, for the sales volume variance, the actual units 123,000 and the budgeted units of 120,000, and then we multiply it by the budgeted price of 26. Now, the sales volume variance is favorable considering that the annual actual units exceeded the budgeted units. So, your basis is the units. Why? We call it sales volume variances. Now, if you want to determine the net variance for product R sales, that will be adding the sales price variance, which is unfavorable, and the sales volume variance, which is favorable. That will give you a net variance which is unfavorable because 123,000 is greater than 78,000. Now, for product S, we have the actual volume computed by the sales revenue over the sales price per unit. So, you get 162,700 units. That's the actual volume. So, for the sales price variance, we are now comparing the budgeted price of 22 with the actual price of 20. So, in that case, the budgeted price exceeds the actual. In other words, there's a variance or a difference equal to $2 per unit. And you multiply that by 162,700, which is your actual number of units. Okay, actual number of units of 162,700. So the sales price variance is equal to 20 and 22 compared times 162,700. You have the unfavorable variance, while the volume variance is 162,700. That's the actual volume minus 150,000, the budgeted volume. That's why the sales volume variance is favorable because the actual volume exceeded the budgeted volume. And we multiply the difference by the budgeted sales price of 22. So, the favorable variance of the sales volume. However, for the net variance, it will still be unfavorable because the sales price variance, which is unfavorable, exceeded the sales volume variance. Now, for product T, the sales revenue product T is 540,000 and per units only at 10. So, the actual volume is 54,000 units. Now, we have the actual price of 10 and the budgeted price is 20, and we have now the actual volume of 54,000. So, the unfavorable sales price variance of 540,000, though the sales volume variance is favorable because the actual number of units sold is 54,000, the budgeted is only 20,000. So, meaning the variance is favorable ang sales volume while the sales price is unfavorable. However, the net variance is the difference between 680 favorable and 540 unfavorable. there's a difference of 140,000, which is favorable. Now, in requirement 2, suppose that product is a new product just introduced during the year. What pricing strategy is used following for this product? Now, it appears that Eastman is following a penetration pricing strategy for product T. The price is well below the initial budgeted price, and the rationale given was that the company wanted a large number of consumers to purchase the new product. These are characteristics of penetration pricing. So we have now number 2 for the requirement in number 20. So we go to the next set of problems. We have now your multiple choice theory and problems with number 21 up to number 25. Okay, let's begin with number 21. This theory type. Which of the following markets is characterized by many buyers and sellers, a homogeneous product, easy entry into and exit from the industry, and all firms are price takers? So it's in the previous problem, it's perfectly competitive market. Next, in number 22, the answer to number 22 is letter D. Which of these products have an inelastic demand curve? Inelastic demand curve. By inelastic demand curve, we mean that even though there is a small percentage change in price, no, that will lead to smaller change in quantity, no, in elastic, because elastic would mean that the small percent of change in price will lead to greater change in quantity. That's elastic. So the change in price is small. However, it will lead to greater change in quantity. Now, product A, the old price is 10, the new price is 11, the old quantity is 2,000, the new quantity is 1,900, which means that this is inelastic. Product B, the old price 20, the new price is 18, the old quantity is 4,000, the new quantity is higher, much higher. There is greater change in quantity. The fact that there is a small percent of change in price. So product C, from 30 to 33, however, there is a reduction in the new quantity. In other words, this is more of answers, products A and C. Now we go to number 23. What's the markup on cost of goods sold? This time our cost of goods sold is 200,000, and the formula is the numerator, selling and administrative expenses, divided by selling and administrative expenses plus operating income, the total divided by the base, which is cost of goods sold. So we now divide 200,000 by 200,000, you get 100%, meaning 100% of cost of goods sold. That's the sum of your selling expenses and operating profit. Number 24 is in relation to variable and absorption costing. And this problem is absorption costing. We have the variable production cost, and we have the fixed production cost. With the variable production cost, that's 40 per unit, and we add the fixed production cost. The fixed production cost of 200,000 divided by 10,000 units. So the fixed production cost per unit is equal to $10. So adding 40 and $10, and the total is no 40 and 20. 40 muna ang variable production cost and 20 is the fixed production cost. So the total is 60, and you multiply that by 2,000 units. Now that's your ending inventory because production is 10,000 and sales is only 8,000, meaning there is an ending inventory of 2,000 units, and we multiply that by the production cost of the sum of variable and fixed production cost. So we have the total of 60. Our inventory cost 120,000. Then the last here, the expected sales were 2,000 units at 100 per unit, but the actual sales only 1,800 units, but what at 110. Budgeted variable costs were 60 per unit. How much is the sales price variance? So that's the difference between 110, the actual sales price, and 100, the budgeted or the expected sales price, and you multiply by 1,800 units, that gives 18,000.